Good morning. Thank you, Brian. My name is Aigboje, Aig-Imoukhuede, and it's a great honor to join you this morning at the 2024 International Capital Market Association AGM and conference. And going by what I saw this early, I checked into the Radisson at 1:30 a.m. or something like that, and I think I saw some conference participants return from the conference. And I thought to myself, wow, I've missed a lot, but I'm here anyway. So I did some homework on the more recent activities of the ICMA. And to be frank, as far as the debt capital markets are concerned, I cannot think of a more influential platform for progress and advancement of these markets, globally and regionally. So as an African whose background and interest is in banking, finance, investments, at least that fuels my philanthropic activities. My interests that span both regional and global markets can be advanced by being a more active participant in what your association does. So I treasure the opportunity this morning to rub minds with you and other capital market stakeholders. So over the past 50 years, I understand that you've provided the foundations for the deepening of the world's financial markets. You've advanced the cause and effect of market-based prosperity. And this is obvious. I mean, capital markets are the bedrock of a nation's economy. So because capital markets properly functioning, channel resources to the best ideas and the best enterprises, it's something that is good for me, is good for Africans, is good for Africa, is good for all of us if we can get our markets to be more efficient. My returns are better, prosperity is achieved and better shared, hopefully. So markets can be a force for good. And the problem, however, is that it's a force for good where those markets are recognized by the powerful and influential players that make the markets. So if you think about global capital markets as they develop, the last figure I got, which was around about 2023, was, the value of capital market assets over 250 trillion. Let's say the debt markets, about half of that. But then you think about Africa's share at 1%, and our population contribution at well over 11%. It's not difficult to understand that somehow, in all this great prosperity that the capital markets have brought to the modern world, Africa has been left behind. And that's what I want us to think about, this morning. So I do agree that our continent, Africa, has to do the following: integrate ourselves with the global financial markets, expand our reach, diversify and strengthen our sources of finance, and of course, ultimately, provide investment opportunities where wealth is created. If we don't do this, I dare say that our path to economic success is obstructed. So this makes the subject matter of our discussion this morning even more relevant. The African risk premium, unfair or justified. And you can imagine how important this is. If African, and let's be specific, sub-Saharan African issuers of debt and equity, focus on debt today, are paying more for their finance than equivalent issuers elsewhere, then, we all love sports. It means that we're playing with one arm tied behind our, in fact, actually, I think more of one arm, one leg, perhaps maybe two arms and one leg, and we're asked to play football. Imagine this goalkeeper who is meant to keep out goals, who is hamstrung because, the odds are stacked against them. The rules making of this particular market doesn't think about the realities of this goalkeeper or this player. So of course, African issuers and the millions that depend on these issuers for employment, pensions, and so on, are therefore going to struggle to remain competitive versus issuers in other markets. And so therefore, if we are actually given an unfair handicap, we have to correct it. The evidence as to whether the risk premium is fair is being gathered by many. Most recently, I came across a working paper, some of you may have, published by the IMF in 2023, looking for the missing factors that make sub-Saharan African sovereign debt more expensive to issue than the equivalent debt from peer group markets. The study took a sample of 1,500 plus sovereign fixed coupon bond issues between 2003 and 2021, almost 20 years, and found that sub-Saharan countries paid coupons significantly higher than similar nations from other regions. Basically, you're talking about a 150 to 100 basis point differential. Now, this is a lot, but the reality is I want you to think about this way. In more normal times, when there is less of the type of VUCA, conditions that have driven the cost of debt to the levels that it is, the 200 basis point premium could account for as much as 20 today to 30, 40% of the actual cost of servicing your debt. Cumulatively, over a 7-year, 10-year bond, that is ridiculous from a competitive standpoint. It could mean that actually the cost of debt over the duration of the instrument actually sees me paying twice or more than twice my competitor of equal rating. Now, the thing about technology is calling for my Face ID, so. So I'm going to use a more practical alternative. I'm not going to raise my and so as I make the case, okay, I want you to have very firmly in your mind this picture of this handicapped issuer. It's very important. And I want you to have at all times in your mind, okay, the millions of people whose employment and whose future and whose prosperity are linked to this handicapped issuer. Could be a country, it could be a corporate, maybe a farming business, and so on. Now, what the IMF paper also said was that this premium reflects the thoughts and biases of rating agencies. Okay? I didn't say unfair thoughts. I didn't say unjustified biases, okay? But the rating agency sets, so to speak, the tone. At this point, it's then fair to say, well, I mean, rating agencies have their role and they have their effect and, and so on, and we all, use them. I agree, okay? But let's not quickly accept it on the face of it. Think about this film, you may have watched it, The Big Short. And there's a character played by, I think, Ryan Gosling, it is. And he's meant to be a Deutscher, I shouldn't have mentioned, anyway, but he's meant to be a trader from a big financial institution. Jared Venet. And he's explaining how subprime mortgage loans have been repackaged into CDOs and have been given AAA risk ratings. And to explain, he builds this wooden tower of bricks, which represents subprime debt, to demonstrate how the US mortgage rating system works. And very soon, as you put the wood on the wood, this wooden tower collapses, as we know. And the global financial crisis follows thereafter. Now, personal paradigms play a critical role in decision-making. Otherwise, how could rating agencies have been so wrong about the backbone of American credit markets? If they could get it wrong there, markets they know, markets they understand, of course with a negative outcome, okay? How likely is it possible that they could also get it wrong in markets they don't know, markets they don't understand? How could the subprime market debt have attracted AAA ratings while the best sub-Saharan African issuers cannot get investment-grade ratings under any set of conditions? Think about it. Think about it. From an African perspective anyway, to me, it looks very strange. And many of us have concluded that it reflects a negative bias. And I'm not saying that rating agencies do not play an important role in global or regional or national capital markets. They do. But if you think about the relatively minuscule contributions by African sovereigns and African corporate issuers to overall global capital market activity, it's likely that they will suffer the indignities of negative bias that, as we know, the weaker members of any society always suffer. Always suffer. Whether Europe, North America, Latin America, and so on. So, if the world is ready to fight so much for the weaker members of society on issues that are very important, that the weaker members of society should not suffer the indignity of discrimination, etc., because they are not understood, how much more the weaker debt issuers from Africa and the billions of people attached to them who suffer so much as a result of the fact that we have not drawn our attention to the nuances, personal decision-making and biases that are taking place within the risk agencies. Let me give you an example. I guess in a rating agency discussion taking place in Europe or North America, when the committee meets to discuss this particular African issue, and they are confronted with the fact that in the discussion and in the analysis and in the visits or whatever, okay, this company cannot physically verify its factory address. And to the rating agency and the raters, it's a major credit issue. That's how we were trained. That's how we think. And fundamentally, there's no problem with that thinking. But then when you then realize that that company had to build its own road to its own factory, it's not strange to then understand why its address doesn't exist on the country's map. You get it? At this stage, I must say it would be unfair of me to lay all the blame at the door of the credit rating agencies. Because this same IMF, I don't know if that's for me, okay? This same IMF paper says that African countries still pay higher issuance costs than peer group emerging market and developing economies from other regions. So it appears to me that beyond a rating agency bias, it is actually the market itself that harbors the bias. And then, of course, when you think that international investors tend to cluster African debt assets together as a single category, with insufficient attention paid to individual countries and their macroeconomic fundamentals, you begin to understand why sweeping paintbrush approaches can do a lot of damage at the sovereign or actual issuer level. So something is wrong with the system. And clearly, as a result of the inefficiencies of the system, to my mind, sub-Saharan African countries pay too much for their debt. And we have to do something about it. Now, for the few Africans in the room, but at least we are at the table, from our side, there's progress that we need to make. There are things we need to do. An improvement in our data transparency will have a positive impact on borrowing spreads. Likewise, improvements in fiscal transparency at the country or sovereign level, and financial development and market depth overall. These are things that are certainly worth pursuing. The adoption of global investment performance standards by sub-Saharan African pension funds and investment funds, putting them on an equal footing with the international fund management industry will help. Then finally, I want to end on this issue of whether the sovereign ceiling can be pierced. An increasing number of African businesses operate across the continent, spreading their risks across several countries. Dangote, the richest man in Africa, has his business, the Dangote Take Cement, for example, operating in 11 different African countries. Access Bank, which I chair, covers 22 countries, half of which are in Africa and the rest in the more advanced economies. It cannot be long before the market should reflect the reality of, one, a diversified portfolio of business, two, an internationalized portfolio of business beyond Africa, and reflect this in the credit ratings of issuers like Access, Dangote, and so on. And if the debt market premiums are addressed, then equity risk premiums will follow. But then I have learned something in the few hours I've interacted with the ICMA. It doesn't make sense in my staying outside this powerful body and not using it. So Coronation will join Access Bank as a member, and I will raise the flag of membership recruitments across Africa, such that next time, or in not too far future, when I look in the crowd, I will see many more African issuers, African countries, African members. And I think with a much louder voice, perhaps if my lonely voice today doesn't convince you to address the issue of the unfair Africa risk premium, our much stronger and louder collective voice over the next few years will do so. Thank you very much.